I think the market is going to be having a hard time transitioning from this really momentum, multiple driven upside that we've, for all intents and purposes, seen since the fourth quarter of 2022 when the current bull cycle started. Our work shows historically that earnings driven markets are still positive, but they're not as positive as
Yeah.
multiple driven markets. I think that's why this week is such a huge week, because we see some of the biggest tech companies come out with earnings, number one. Number two, we've had tremendous performance and outperformance the last week or 2 weeks from the small mid cap area, which we've been talking about for a couple of years. We were pretty early, but at the end of the day, we think a broadening out of the market to more small mid caps is actually quite positive for the longer term breadth and
Right.
positive nature of the overall secular bull market that we continue to call for.
Paul, NASDAQ up 18% 1 year, S&P up 13% 1 year, Dow up 11% 1 year. I believe that's double-digit performance.
That's double-digit performance. Brian, Thomas is calling out some solid returns for U.S. equities, but and you think about 2025 and even the start here of 2026, rest of world, other markets have done a lot better outside the U.S. How do you think about the U.S. versus rest of world?
It's a great question, Paul. 2025 was a snapback year, principally because I think a lot of political side of things and the fear trade leaving the United States. Then you also had the currency weakening, and then you've had the currency strengthening in other areas. And we do think that the value proposition, certainly of Europe and some emerging markets, was an attractive play. And then you talk about our brethren in Canada, which how Canada had its greatest net outperformance on a local currency basis since 1990 relative to the U.S., mostly because of gold. But even though gold gets a lot of headlines, the banks in Canada really rocked it in 2025, especially considering the reserves that they had been, quite frankly, building over the last several years. So I think the Canada trade is going to be tougher this year. I think in terms of the other markets, I think it's going to be tougher. I think we're going to have a little bit more balanced across all markets, especially given the fact that now we need to see fundamental growth going forward for emerging markets and going forward for Europe. And it's not just going to be all about the materials and the energy side.
I look, Brian, at the makeup here. I want you to talk to people in their 401k, like me, that stumbled into decent returns over the last number of years. Should they reallocate? Should they rebalance? Or is it just static? Keep it the way it is. Patience forward.
Patience forward has always been our line. We're not the smartest person on this call right now, by the way, or on this broadcast. And
I know Michael Barr just entered the room.
Yeah, well, there you go. But at the end of the day, we have a report coming out today on our website under our new moniker called Belski Briefs, and we talk about the importance of remaining longer term invested. If you miss the best days in the market and you try to trade the market out since 1990, the average annual return is 8.6%. But when you miss the best days of the market, which typically, oh, by the way, follow the worst days in the market, your annual compound annual growth rate in terms of your portfolio is going to be 4.5%. So just it sounds mundane, but be invested. But what we think is you want to broaden out what you're owning, Tom, in your 401k. Let's call it more value, more small mid cap, more dividend growth. Not at the expense of selling the Mag 7. We still think you need to have some exposure in tech, and we're equal weight tech in our work. But at the end of the day, you want to be invested U.S. stocks. Now is not the time to run away based on fear or rhetoric, and especially with respect to what's going on in terms of politics.
Brian, how about the bond market here? The 2-year Treasuries yielding 3.60 here. That's a nice living there for a lot of folks. But should we be taking some credit risk above and beyond that?
We think bonds still remain an important part of anyone's longer-term portfolio. I think the bond market has really been kind of a forgotten asset.
Right.
We're thinking and talking more about private equity. I like the bond market here, especially around this zone. And we've been talking now for the last 2 or 3 years that this 350 to 450 range, it's a wide range, but that is returning to more normalcy that we've seen in markets for the last 30 years. And I think that's where we're going. And within that range, Paul, I really think that's an area where we should own bonds.
Brian Belski with us with Humilis, and of course we've got a Segui here into the reality as well. Brian, I mean, there's no one we speak to who's more attuned to the ability of Sam Darnold to come over his shoulder and pop that puppy down 40 yards. I mean, you go back to when the Vikings lost him to Seattle. You go back to Seattle winning 26-0 against the Vikings this year. Brian Belski on Darnold and the Patriots.
Oh my gosh. Well, I'm going through the rosters here of the ex-Vikings in the Super Bowl, which is kind of, like, so you think about Stephon Diggs and the Patriots and Sam Darnold, who obviously in Minnesota Sports Radio, which we'll be listening to on this interweb thing, this www dot thing. It's going to be crazy in Minnesota Sports Radio today because, we're a bunch of masochists in Minnesota sports. So I'm sure that people are going to be mad that Seattle is in Super Bowl. I think it's amazing in what Sam Darnold's been able to do, and they played a great game yesterday.